Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement. Our show is all about building up wealth, understanding the world today, and dealing with retirement. Our motto and our philosophy is to save aggressively and invest conservatively. Save aggressively and invest conservatively. That's the key to building up wealth over the long term. Always start out with your company plans, your 401ks, 403bs, your different types of programs. Put away 10%. Plus, get a company match, and that gets you around 13 average. Sometimes it's quite a bit more. You get 3%, 5%, 4%, 7%. It's all over the place, but the number is 13%. If you're putting away that much money, that's going to get you where you need to be for retirement. And so remember, just save aggressively and invest conservatively. If you're not there, if you're behind in your retirement, it's never too late to start. You can put away money once over the age of 50. You can put additional funds in. So there's opportunities, and that's when you typically make your big money is in your 50s. Really ramp up your retirement. Start saving today. Take charge of your retirement, and protect your family from a world of out-of-control spending. The U.S. has $37 trillion worth of debt. They're probably going to run. The last 5 years they were running close to $2 trillion deficits per year. Every year deficits been over 6% of GDP, except one where it was a little bit under 6%. The last time we saw that was in World War II, and we're just blowing through money now, not to defend the United States, not because because our lifestyle is threatened. It's just we're just spending money for the heck of it, and this isn't going to end well, and we all know it. And so protect yourself today. Understand the world we're living in, and take charge. And then what we talk about is diversifying your assets into different asset classes. As we said, one of the themes on our show for a number of years has been, look, the time of the S&P 500, 60-40, 60% of the S&P 500, 40% in long-term bonds is over. You have to have a more diversified retirement plan that takes into account overseas stocks, takes into account precious metals, takes into account commodities, and even foreign bonds, because we've become more global, and the U.S. has become unstable with the sheer amount of debt we have. And so here we are today. The market, the U.S. dollar, it's had the worst year since 1973. At one time, it dropped 11%. It's the worst year in 50 years. Yeah, and there's a reason for it, as we talk about with these issues. But if you look at something like the precious metal sector, it's done pretty well this year. It's the top performing asset class is precious metals, and so there are opportunities. There are opportunities to do things to take advantage of. If you look at gold. Gold's up 53%, 53, almost 54%. It's the top performing asset. Emerging markets, number 2. Gold was up, it's just incredible, over 50%. And so this is what we talk about, the importance of spreading out your assets in different things. The same with corporate bonds. We like very high-grade corporate bonds, because in a world where the government's spending money constantly, if there's ever a crisis of confidence in the U.S. government, if you look, the only alternative is very high-grade corporate bonds. And kind of the disturbing thing about that is that the spreads are very, very tight on corporate bonds right now. Now, That's only justified, in our opinion, at the very for the very high quality bonds. We try to look at A, or actually like double. I really prefer for as an alternative the government's double A or better, but it's got to be for certain type of bonds. We don't want to. We're not big fans of financials, maybe because they destabilize too quickly. And if you're buying something as an alternative to the government bonds because you're concerned there, whatever those bonds are, they've got to be rock solid and can ride through various types of scenarios. And so again, we do a lot of work with that, a lot of management of your retirement to protect you and do risk management to deal with these just very volatile times in the markets. And many people have been kind of lucky with they've held in through various crises, and the market's always going up. I mean, they forget about I want to say the Dow Jones. I want to say it was 1968. I think it got around 1,000, and then it didn't break through there really decisively. It would go to 1,075, 1,059. It really never broke through it decisively up until 1983. There's other times in history, including more recent, where we've had 2, 3, 5, 10 years or more of no change in the Dow Jones. It's a little easier. The same with the S&P. And since '99, in particular after the great financial crisis, the Fed has flooded the system with money every single time there's a hiccup in the market or anything, and they're basically just depreciating the money, and markets are going up, and people are, we're making all this money. Well, you're really not. The government is just printing money, and so you have to protect yourself. People have got wise to that. They're starting to come into these different asset classes, and they're taking advantage and understanding the importance of proper diversification. I mean, one of the more fascinating things about the S&P 500 is it's very, very hard to beat the S&P 500. We've been fortunate here, over the last number of years, but on total, but it's just it's very difficult. And some years we beat it, some we don't. But I don't want to give the impression every year we do, but we do an incredibly good job, I think. But the important thing to understand is it's very, very hard to do that. And the reason why is because the S&P 500, what they've done is, if you look at it, depending on the number, it's 5 stocks are about 27-28% of the average. And then if you really look at the technology sector and do a fair analysis, the S&P Standard and Poor's moves. They have Amazon in the consumer discretionary. Keep in mind, Amazon is a massive data center company and everything else, but they're in consumer discretion. If you look at Tesla's, I believe, in automobiles. If you look at Google's advertising. Well, what they're able to do is they're able to prevent an over. If they really had, all these are basically technology companies. They were all in technology. What we'd really be looking at is weightings of 39%, and so it gets very hard for advisors to hold through these positions with these big types of concentrations. And whereas the S&P 500, they just kind of rename a few stocks into different industry groups and get away with it. And so, but this is like I said, we think this is coming to an end. I think we're going to look at a lot more. Some of the things we're looking at is, look, we think the economy is slowing down. Let me give you some numbers here. What we've been saying, we think the economy is slowing into year end. Now AI business. It is the biggest boom town since 1929 in the 1949 gold rush as far as AI. They're throwing money. You can't. There's money raining from the sky out there, and the reason they have to use crypto is because if they in electronic money is because if they printed dollar bills, they cut down all the forests in the United States with all the money they're printing. But if you get away from that, I was talking to a friend of mine. He's telling me, Ted, the last 2 months have been the worst in the restaurant industry since 2020. I talked to a lot of people out there. Automobile sales, a lot of things are going down. And one of the things we've been saying is housing, everything else, is because right now the U.S. is trying for the first time since 1950s. Uh, Eisenhower had a program. I won't even use what they called it because I'll get phone calls complaining I'm racist or something. But uh, he had an operation that basically they removed millions of illegal aliens from the country after World War II, and now we're doing the same thing for the first time. ISIS is working heavily to do it. But a lot of illegal aliens have been here for 5 or 10, 15, 20 years. They're very solid citizens and stuff. They're great people, but they're all worried they could get caught up in the raid to get rid of these illegals that Joe Biden let in when he basically announced that the United States no longer were going to enforce their borders. And so these people, they're trying to get rid of them. Well, the legitimate people that have been here for years, they're afraid to go out of their house. They're afraid. They go to work, they come back, they're afraid to go to the grocery store. They'll go to the grocery store, but they're not going out. Looking at some numbers, I just came across some numbers here. If you look at the FHA housing, what they came in at, typically it's about 4 to 6% has been immigrants. They doing loan locks for immigrants. Well, that's dropped to 0.25% here recently because these people, they're afraid to go buy a house because if they go buy the house, they move in and they get captured and sent out of the country. And so this is why we're seeing automobile sales slowing down, housing sales slowing down. So we think the economy is slowing here, and there's just an enormous amount of speculation in the markets, but that's our thinking. Now, Donald Trump has announced $2 trillion worth of factories are coming to the United States. But the number we're using is about $500 billion. We think that's a harder number. That look, what are we really dealing with? And we think that's kind of the number. Well, that's pretty good. Well, these factories, they're going to take 6 months to a year to permit and get started. So the people are announcing the factories now. They've been doing it since April, since the beginning of the year, really. So the factories are starting to come up. They're building the factories. We're going to see these opportunities. But right now, understand that's likely going to be a story for next year. We're going to have a lot of AI spending into next year too, and so we should have a reasonably good year next year. President Trump wants the economy pretty good for next year for the congressional elections. They don't want to lose the Congress. So what they're going to do is likely we're going to see some type of program for maybe immigrants that have been here a little longer, some type of program, or I don't know what they're going to do, but they're going to likely ease off the pressure by the first of the year. But for now, I think it's a slowdown. Now, the thing that makes this really tough is there's such an absolute frenzy in the stock market right now. I mean, this is one of the hottest markets. I talk to a lot of people, I read a lot. Everyone's kind of like, the speculation is just off the charts in the stock market. Now, normally the market's behind. Most institutions are lagging the S&P 500, and so they're going to try to start buying into the market because they want to look good for their clients into year end. This is a little tougher one here. It can go either way, but if it ramps up in the next year, then you're likely to see a recession, a big sell-off early part of next year. I mean, if I'm Trump, I don't mind the market selling off a little bit right now as long as it's up because I want the correction out of the way. Again, what I want to do is a good market for next year so people are happy. So this is some of the things. There's this real dichotomy out there in the world. The wealthy people are doing good. The top 10%, they have a lot of stocks. They're doing great, although that's starting to slow. You have the middle class hurt by inflation, and then you have many of these immigrants in real trouble, afraid to spend any money. And that is really starting to affect things. You're seeing it in auto sales and other things. So I think we're going to kind of try to expand upon this, and we're going to be talking about this massive move in the precious metals. The biggest bull market in the last 50 years is happening right in front of us, and why it's happening and where it goes from here. The gold market had a big sell-off Friday. What's going to happen next? We're going to discuss this after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings investments in your retirement. I want to go over what's happening in the precious metal sector. Again, this has been the hottest part of the market right now. We've talked about this for years. Gold has outperformed the S&P 500 for like almost 20 years now, actually, if you run the numbers. And gold hit 4,300 yesterday. And for almost $4,400. It closed at $4,250, reversed down. It's had a huge run. I mean, we're talking gold is going up almost $1,000 in the last 2 months. And what's going on? And basically the same with the silver market as well. Silver has run up dramatically too. And this is about fears of dollar debasement. If you look at silver's about $38 or something like that. It hit 54, back down to 50, 51, $52. And what you're looking at is these are huge returns. I think silver was up like 70% year to date. And it's a debasement. It's a couple things. It's a debasement trade. And people are concerned about the currencies around the world, particularly the dollar, being debased. As we talked about, the dollar's fallen 11% year to date. We have massive deficits. We have massive $2 trillion annual deficits. We have $37 trillion in debt. And the other really important thing we did is Joe Biden was so desperate to for his opportunity to take out Vladimir Putin, they froze China, they froze Russia's foreign exchange reserves at the Federal Reserve, their treasury holdings. And once they did that, every major country in the world had to start making plans to reduce treasury holdings to protect themselves from war or diplomatic disputes where their assets are locked up. And that's led to if you can almost see the move up in gold from October of 22 when this started happening, is countries around the world started buying gold and silver. Russia's been very shrewd about Russia's been very shrewd about using gold to purchase assets overseas. If they want to buy weapons, if they want to buy materials, they come in and they're able to they'll trade their gold for the weapons. They'll trade their gold for critical assets that they need, and they've been very successful at it. Well, China has seen this, India's seen this, Brazil's seen this, Iran's seen this. Saudi Arabia, all these other countries have seen this, and so now they're ramping up because they want to have gold too. China's been the biggest buyer of gold by their central banks, and what they've done is they're now making in Hong Kong you can deposit your gold there and convert to yuan or go convert yuan to gold back and forth, which is making it a currency that people can use around the world and as an alternative to the dollar. And this is the reason why gold has gone up, and it just keeps going up. I mean, and so it's a fear of the debasement of the U.S. currency in other currencies. I mean, France is a complete basket case. They've gone through like 6 prime ministers in 18 months. I mean, they can't. The minute they try to cut back their entitlements, which are completely out of control, the strikes go down, and then the prime minister resigns. And so what you're doing is you're sitting there and having to deal with the Japanese. They just have a new person. They've got their debt to GDP is about 237%. Their 10-year bond has been going up. Rates are going up on them, and so there's around the world there's issues, and so gold is an alternative. The central banks can put it into their vaults in addition to holding euros and dollars and maybe yuan and Japanese yen. It's an alternative that's outperformed all the rest of them, and so that's really helping out. Now, here's where it gets interesting: is if you look at it in 2020, the Chinese and Indian buying was about 20% for gold from India of the demand, global demand. It's now 50%. And this is something we've talked on this show for months, is everybody, the United States, in the 1973, everybody was buying gold. 1970s, they were all buying gold in the United States. We had all the money. The Europeans didn't. We drove the gold market higher. Now it's the Chinese. Now it's the Indians. These people are. China has a huge population, over 1 billion people. India does in there as well, and they're buying gold and silver. So they're the incremental demand. There's been lines in China to buy gold, in Japan to buy gold, the Asians, and India to buy gold. So individual investors are buying gold. And if you look at it, we have the SLV and the other different gold ETFs. Well, in India, they've had to shut them down because they cannot get the silver or silver ETFs. Kotak Management basically froze their fund to new investors. The State Bank of India's fund, that closed down. India's largest precious metals refining company ran out of stock for the first time in its history. And so we're seeing huge demand globally for gold and silver. People are lining up. And so the thing about this is, in the past, when it's been in the United States, a lot of speculation has been in the commodity markets. You had the Bunker Hunt, and the Hunt brothers were in there, buying, and then they froze. They raised the margin requirements, and then they said liquidations only. And even though they cornered the market, the thing collapsed. It's the same. and in the past, when they had moves up in gold, the COMEX would raise margin requirements and everyone would quit buying and the price would go down. Well, these people in India, they don't care about margins. The people in China, they're not buying on margin. These people are paying cash and they don't care and they want the metals. And then when they see it's out of stock, there's what, the 8 billion people in the world today. There's not much silver out there. And silver, the demand since 2021, we've written about this in our Max Out Savings report, demand for silver has outstripped supply every single year. It's been a $678 million deficit. And so the excess silver of the 2000s is gone. You know, when Kodak quit making, when they made the transition from film, which uses silver halide, over to electronic images, huge drop of demand for silver. Now we have massive demand for solar energy around the world. They need huge amounts of silver. They're not finding many big silver mines. They're not finding many gold mines. Barrick's probably found the best one this century, just recently announced over in Nevada, but they haven't found that many. They haven't found many big mines anywhere, and so. But silver. One thing about silver is used. It's an industrial commodity. It's used in electronics. It's used in electric cars. It's used in solar panels. It's used in industrial uses, and that silver kind of just disappears. So where do we go from here? You know, on the silver part, look, gold's expensive. It should have some type of correction. This has been a massive move up, and I think gold and silver corrected here some. It's hard to tell. This has been just such a spectacular run in the gold and the silver. I think silver goes higher. I think the demand for silver is gigantic. I don't think they have the capacity out there, and I think it's not as big a market. The gold market is about $30 trillion. Let me see. I'll try to pull up the size of the silver market. It's not that big, and since gold's expensive, a lot of investors are buying silver, and so I still think silver goes into $65 to $100 range level. It's just, you know, there's so much demand for solar. There's so much demand out there across the board, and it really blew through 50. It went through 50 this week. And one thing you got to understand with silver is it went through 50 this week. That's the first time it's been through 50 since 2011. The last time it hit 50, it didn't go through 50 in 2011. It got near it. Last time it went over $50 was in 1980. That's 45 years ago. And just, you know, run any type of inflation number on $50 45 years ago, and you look at much higher prices. And so that's what I think we're really looking at with this. I think the silver is going to continue to outperform. If you look at the metals stocks, and you know, we get a lot of questions on gold and silver, so I'm going to try to get some of them answered here. If you look at the metal stocks, the earnings continue to surge up across the board. If you look at most of the metal stocks and you put them up against the Mag 7, there's no comparison. The earnings growth rate is materially better out of the precious metal. Keep in mind, do we have a call coming in?
Yes, call from Chuck.
Okay. Oh, Chuck?
Hey, Ted.
Savings show.
Yeah, I'm wondering if we haven't reached a situation where there's a gold shortage, because not only do you have this foreign buying you're talking about, but I read every day in the paper all the investment advisors here are saying move 15% of your assets in gold. Well, there isn't really that much free gold out there, and I don't think they mine that much. So at some point, you're going to have a shortage of gold too.
No, I think that's it. I saw some numbers. Let me see. I wrote them down here. It seems like the actual, I think it was 39% of the institutions have zero gold waiting. And they're just not in it. And I think it was Bank America. I think their number was, here it is right here. I actually wrote it down. Private investors have at Bank America have a 0.5% allocation in gold and silver. I think that's gold, and a 2.4% allocation for institutions. Now, the private thing, I don't think J.P. Morgan is or Bank America is picking up on, physical gold that the individuals own, so that number is likely higher. But the number for institutions is 2.4%, and it's the hottest asset class out there. And to your point, they're scrambling to get in, and they're having trouble getting in. And so, that's why I don't think it's over. And I think it kind of moves higher. And then, to me, the one thing that really I think, particularly so, if you look at the Asian demand, I just don't see this thing letting up yet.
Yeah.
Does that answer the question?
Yeah, no, like I said, there may not be as much gold out there, and if people start shifting assets, institutions, it's going to keep this price up there.
Yeah.
Thanks,
I mean, I think if you get this is a good question. I think you can get a good you can see a good correction here, and so that's it. No, that's what we're thinking, and also the miners look good. But thanks for the call, appreciate it.
Sure.
Now, one of the interesting things. By the way, this a caveat we've got to put out there. If you have big positions in this, you have to kind of manage them through, which is not easy, and you don't want to sit there and look. Can gold go to 5,000 or 6,000? Yeah, I think 5 is probably a reasonably good number, but could it top here and go down? That's possible. And so I do think you have to manage your assets. You do want to have some risk control in place, and you do, sell some as it goes up type of thing. I mean, I think that's something you want to take a look at, particularly after this massive run. So, we really like the sector and stuff, but understand, you do want to pull some off the table. That's what we've been doing here. Actually for a couple of weeks, we did some Friday actually in the morning, and so we've been really exceptionally busy here the last couple of weeks. It seems like everything is working real well, but it requires a lot of work. So, but that's the one thing. But I think to Chuck's point, look, that's most institutions, 39% of them don't have any in the precious metal sector. They're lagging pretty badly. I think it's going to continue going up. I mean, after this correction comes in, we'll have to see where it goes. But that's going to be the real thing to sit and look at with these markets. And I wanted to touch base on the stocks themselves. If you look at it, these companies have better growth prospects, or better not growth prospects, but a better earnings track record than the technology companies. Yet many of them are at 13, 14 times earnings. We talked about Barrick having a new mine, and they're still at that number, a big new mine, huge new mine. And oil prices are low right now. They're continuing to cut costs. But basically, the precious metals companies that were the oil and gas sectors were about 3 or 4 years, around 2020, where they finally said, we're done with just getting as much production as possible of oil. We're going to try to manage for cash flow in earnings and reduction of debt. And the same thing is happening in the gold sector. I think Newmont announced they're going to be having some layoffs and cuts, even though gold price is this high, because the people want to see these earnings come up. So I think they're going to have a good run of earnings. The prices they're looking at are spectacular right now. Plus, energy costs are low. Almost every other gold run I've seen, oil's been up at the same time, and it kind of hurt a lot of those guys' earnings. Not this case at all. And it does appear to be spreading. I think it's gonna. This is going to kind of spread out to other commodities. We really like copper. Copper is at the absolute centerpiece of AI, of electricity, of electric cars. and of the factory build out, one of the huge fundamental shifts which Donald Trump has put in place is the massive reshoring of manufacturing back to the United States. Copper is at the center of every bit of that, and so I think you're going to see this expand out to other areas as well in the mining sector. Tell you what, let's take a quick break and we'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka will return shortly. To speak with Ted Gioka now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Ted Gioka, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues. And that's where Ted Gioka can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3. The Answer.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to MaxOutSavings.com to set up an appointment. That's MaxOutSavings.com. Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, MaxOutSavings.com. That's MaxOutSavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, MaxOutSavings.com.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. Talking savings, investments in your retirement. And we're talking about the markets, talking about the precious metals, which had a huge run, absolutely massive. It appears to be correcting to some extent, and it's technically the gold and the silver market is overbought. I mean, the question is when you get this type of physical buying around the world, where does it stop? And that's a tougher thing. But there's a shift. People are looking as gold and silver as an alternative to to out of control spending, to trade wars, to just one thing after. I mean, the list goes on forever here lately. It seems like. But this is opportunity. I mean, we have a lot of problems. I mean, we've got Russia. We're dealing with the Russia war, which I think we've been all over that from almost the first day, pointing out it was going to be inflationary. But I've really been very surprised we've not been able to get a deal out of Putin. China, the trade war heated up again with them. I mean, it's not going to be easy with dealing with the Chinese, and then we also have the Mideast war, which hopefully we've got that straightened out. But we're reshoring the factories back to the United States, this is part of President Trump's plan. I mean, people are really kind of missing the point. Donald Trump has looked at this $37 trillion deficit. Yeah, he's looked at the $2 trillion a year trade budget deficit. And look, he knows about it. He's got one of the top financial people in the world, in our opinion, Treasury Secretary Bassett. They have a plan. Their plan is, look, we got $37 trillion. We're in trouble. Okay, if interest rates go up, we can't fund it. The interest expenses are now the number 2 expense. Social Security, and that is number 1. Number 2 is the debt, and number 3 is defense. That's just how serious this has got. So the only way we can get out of this is 2 things. we're going to have to inflate our way out of it with a massive inflation. A, or B, if we try to grow our way out of it. Well, Trump looks at China and goes, well, these guys did pretty good since 1995 when they came in the World Trade Organization. I don't think they had an economic slowdown until 2008 in the great financial crisis. Then it kept going. What did they do? Well, they went and stole all our factories and moved them to China. So why don't we get the factories back from China to the United States, and then we'll grow like China did? And that's pretty much what he's trying to do. And he's sitting, these big corporations, honestly, they've not done the American people or the United States any favors at all. They're multinational. They're like students of the world. Every year for years they were trotting over to Davos and, swearing allegiance to Klaus Schwab, moving factories out of the United States, moving factories to Ireland. Ireland's one of the biggest, if not the biggest, drug manufacturing hub in the world because they have low taxes, so the United States pays the highest rates in the world for drugs. And to quote, fund this research was so expensive, otherwise we'd never have the drugs. And what do the drug companies do? They move all the production and screw us because they don't want to pay taxes here, and it costs American workers their job. They're moving them back now. Okay, so he thinks he's like our numbers. But have $1 billion worth of factories come. That's a lot of hiring. That's great because AI is coming and that's going to reduce hiring. So he wants to grow it out. Number one. Number two, he's looking at cutting government expenses. The Elon Musk Commission, the Doge Commission, they basically have found about $200 to $250 billion worth of expenses they can cut. So they're cutting those things. And they're working to cut the government. That's so growth, cutting spending, and then they do tariffs. You can either raise taxes, everyone, or you can do tariffs. What happens with the tariffs? Two things. It causes people, number one, it causes people to move their factories back to the United States. It creates growth. And number two, it creates income. So we if with a little luck, we can get $250, $300 billion worth of tariff income coming to reduce our annual budget deficit. Okay, so, and then the fourth thing he's doing is he's pressuring Chairman Powell to cut short-term rates because what did we say? Interest expense is the number two cost of running the government. So if we can cut that down by cutting short-term rates on the Fed fund size, where we're borrowing a lot of money short-term, that would further reduce the deficit. And that's the plan. It's a good plan. And so we think over the next couple of years that's going to play out. Right now there's a lot of cross currents. There's an economic slowdown. There's clearly a huge housing slowdown out there. The restaurant business is slowing down. Automobile sales are slowing down. And so we're kind of going through this transition period now. But out there should be opportunity. And that's going to be one of the keys is you pick up these opportunities as they come up. We talked about, I think next year, I think oil and gas could be a pretty good play. Oil and gas at $57 is very cheap. Eventually the oil companies are just going to keep cutting back drilling, and production is going to fall because they're just not going to pay for growth. We're in a couple. I was actually on the phone to one of the big Houston independents, and they're like, we're one of the few people that are even exploring for oil and gas out there right now, and and they've got a pretty good growth curve. The stock's at 8 times earnings, and they've got the gigantic new field coming on in 2028. Well, none of the analysts are looking at that because it's 2028. Well, we're like, we know the field's going to be there. We know it's coming in, and I'm buying it at 8 times earnings. Hey, I'm willing to sit there and tough it out and wait, and I'm pretty sure we're going to make money on it. Those are the type of opportunities that are out there. And it's just the AI is a little tougher. I mean, for us, it's just, I'm not sure how they're pouring an enormous amount of money into AI. Now, there's going to be a huge amount of money made with AI, but everybody is not going to be a winner. I mean, right now, Wall Street is viewing AI like basically the soccer league for your 6-year-olds. Everybody gets a trophy, and I don't see that happening. I think there's going to be winners. I think there's going to be losers. The question is how can people pay? How much can they pay for AI? If you're a big company, you can pay an awful lot. And the question comes in is, do other people not? Does it cost the average person so poorer people can't afford AI? I mean, there's a lot of issues with AI that are going to have to be worked out. Where are they going to get the electricity for AI? I mean, at the rate they're going right now, the AI is going to burn through all the oil and gas. And I've heard we're going to lose all the oil and gas in 100 years since the 1970s. That's going to happen because AI is ramping up energy demand so much off the charts that literally it's likely to happen. Now, there's opportunities. The quantum stocks, we looked at that. We're investing in one of the quantum companies. Why would you do that? Because it uses 1/10 of the power of AI. 1/10, and another friend of mine told me he thinks it's 1/100th. After we studied this enough, I'm beginning to believe. I really am starting to believe. I think our brains are possibly quantum computing, just because of the huge amount of computation goes on in your brain with such a low level of energy. That seems like the way it should go, but that's kind of far out there. But there's opportunities. And by the way, when it comes to something like quantum, which is very risky, you don't take big positions in the portfolios with these type of things. You want to spread your risk out. You want to make long-term bets in different things, and you just wait till patient. You wait patiently for things to happen. And if you're sort of in the direction things are going to go, good things are going to happen. And this is why we do so much kind of future work of like what's going to happen next, because it gets us into those positions ahead of time. And the other real important thing, it lets us manage risk, because at the same time we're finding out what could go wrong. One of the things this week is a couple things have been happening under the radar. The banks reported the first day of earnings. Wells Fargo, J.P. Morgan, they all had great earnings. Things are blowing and going. It's fantastic. And then the regionals come out, and there's a number of the regionals that are having issues with loan losses. In Zions Bank sold off 5% in one day, and the whole group started selling off. And the other one that this is happening to is the private equity guys. If you look at Blackstone, if you look at companies like that, they've been selling off. KKR, the same thing. These companies are selling off to some extent, and there's concern. There's issues in private credit. They've been lending a lot of money. A lot of it's covenant free, and so that's slowing things down. And why that's a really big deal is because, keep in mind, we talked on this show a couple weeks ago about Tricolor, a huge lender to automobile for subprime and automobiles, and then First Brands, which was they own a lot of companies that make auto parts. That went into bankruptcy, and then somehow they managed to lose $2 billion. We don't even know where the money went. And when you see those type of blow-ups out there, and you see what's happening to the bank, a couple of the banks, and you see what's happened to private credit guys, here's what happens. All the other guys in the business start going, well, hey, Ted, how are we set? Is our portfolios good? Maybe we should tighten the credit. And you're going, well, we're watching closely, and we've increased our safeguards, and we're also requiring higher levels of credit or more covenants, and that's going to slow down the whole business. So there's cracks forming out there. The slowing of the auto industry, the housing is definitely slowing down out there right now. And so you've got this move. I noticed one of the institutions like the least was the stable demand companies. To us, there's some opportunities in the sector there. I mean, again, because if you go into recession, stable demand does well. And if they're much more around the global companies now, and they're going to be much more stable companies, and if you can get them at reasonable prices. there's always opportunity out there, and I say this: you don't want to get sucked into these big trends. We can probably say gold's starting to get up there, but tech is clearly up there. There's a complete frenzy in that sector, and also small stocks. This is the other area that we've had some small cap stocks, which we just started just blowing them out because they're, they were up so much. I'm like, and we couldn't justify the price. And so I'm like, God, the stock is approaching 20, and some of the people, their target was $10. And you're like, and so one of the messages today in general is, look, this is a very, very hot stock market. This is a 99. This is like maybe 68, 67, somewhere in there. You had one. This is a real, real hot stock market. Don't get carried away. Continue to manage your risk in it. Keep thinking things through. Keep adjusting. And I think this is really probably the best message. There's a lot of big issues out there that are real problems, and you have people are really throwing caution to the wind. And I think it's important to sit there and really manage your risk, manage your understand if something goes up, take some off the table. We really like to let things run. We're very, very tax efficient, but we've just done a lot of selling in here, and just trying to manage the risk to the portfolios, and you should with your same thing. Don't let all the hype on CNBC
2 minutes.
Throw you off your game plan. Would be my advice. Now, a couple things. We just sent out our Max Out Savings report last week. If you didn't get a copy, check your spam box. It's maxoutsavings.com. If you'd like a copy, just go to the website, maxoutsavings.com, and you can sign up for the free report. We send it out once a month, and that's it. It's a private report, private list. We don't charge for it. And if you need some help with your retirement, I'll be happy to sit down with you here in Houston, Texas, and go over your financial situation and see how you're set for retirement and show you how we manage money using our value investing approach to the stock and bond markets. Just go to maxoutsavings.com. That's maxoutsavings.com. And you can sign up for the free report, or you can request an appointment. Just get the phone number and just give us a call, and we'll set something up.
1 minute.
No. Okay. A couple things to remember. As we said, very, very hot market. Make sure you have a risk management in place. Make sure you're don't get caught up in the hype. Remember also our motto and philosophy, which is to save aggressively and invest conservatively. That's a key to building up wealth over the long term. Save aggressively and invest conservatively. And protect yourself when you retire. Anyway, I hope everyone has a great weekend. We're just about over. Next week we should be on Saturday and Sunday. There's no Baylor game, and I did notice. I think Texas A&M is now number 3 in the country. I just wanted to point that out. I hope everyone has a great weekend. We'll see you next weekend right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.